Good evening. My name is Corey Arthurs.
And I'm Madison Dooley, and today we will be presenting our financial analysis of two firms, Pepsi and Coca-Cola.
So the first question we'd like to answer is who our shareholders are. Well, for Pepsi, 75% of their shareholders are owned by the institution, but 23% is owned by the top 10 institutional holders, with Vanguard at 1.9% being their top institutional holder. And for Coke, 68% is owned by the institution, with 34% being owned by the top 10 institutions. Berkshire Hathaway is their number one investment holder, with 9.8%.
Our next question is, do they care about cost of capital and why? Yes, both investors and debtors care. Investors care because they serve as a snapshot of the expected returns, and debtors care because they represent the trustworthiness of loans issued and bonds purchased.
We also like to answer, what is our cost of debt financing? Well, Pepsi and Coke both have a rating of AAA, with a default spread of 0.85%, with an estimated pre-tax cost of debt at 2.56%. So taking this into calculation, Pepsi carries a cost of debt of 1.92% and Coca-Cola of 2.16%.
What is our cost of equity? Cost of equity is best described as the required rate of return an investor places on the company when making an investment in issued equity. Pepsi's cost of equity is 2.73, while Coca-Cola's is 2.62.
So what is our overall cost of capital? Well, stable companies maintain lower levels of cost of capital to protect the value of future earnings. For instance, future cash flows are worth less in present value terms if companies have a higher cost of capital. So after calculation, Pepsi has a cost of capital of 6.3%, while Coca-Cola has one of 6.49%.
Could we lower this by changing our capital structure? This calculation incorporates the operating leases of the firm. The lease incorporates the current year as well as the duration of the leases projected till 2020. We did an optimal analysis, and the results are Pepsi is at optimal cost of capital, but Coca-Cola could reduce their optimal costs.
So how would a financial restructuring affect the value of a company? Well, financial restructuring for Coca-Cola can increase their value per share from $43.35 to $60.97. It can also increase their enterprise value from $242,000 to an optimal level of $320,000. And for Pepsi, it could increase the enterprise value from $165,000 to $166,000, while decrease the cost of capital from 2.57 to 2.56.
Would more debt create unnecessary risk? For Pepsi, an increase in debt to capital from 17% to 20% would increase their cost of capital, which would remove the company from optimal position and therefore increase cost and risk. In Coca-Cola, their current cost of capital is 1% higher than optimal. Payout earnings and revenue equivalent to company inflows and decreased risk, which would mean increasing capital through equity or selling off portions of debt.
And what does the competition do? Well, Dr. Pepper has the highest earnings per share and net income, while Pepsi falls short in some other categories. But the company also has the highest revenue. Coca-Cola showed the highest dollar amount in the balance sheet with a total of $92 million, with Pepsi in second place at $70 million. And Dr. Pepper Snapple Group with a value of $8 million.
Is our stock price fairly valued? One method of valuation is to multiply price per earnings by earning per share to get the value of the stock. On the last day of 2015, Pepsi stock was valued fairly. Today, the company is relatively valued fair. However, it is slightly overvalued. The same method of valuation on the last day of 2015, Coca-Cola stock was valued fairly. Today, the company is also relatively valued fair. However, is slightly overvalued.
We hope you found this presentation educational, and we thank you for your time.